Have you ever thought you could start investing with a small budget? Well, it might surprise you, but the answer is a resounding yes. The world of investing is not an exclusive club reserved for those with stacks of cash. It's a journey that often begins with a single step, and even a small amount of money. We're here to debunk the myth that you need to be a millionaire to start investing. It's important to understand that the key to successful investing isn't necessarily about having a lot of money to start with. Rather, it's about making consistent contributions over time, understanding your investment goals, and having the patience to let your investments grow. Don't let the fear of not having enough money hold you back. You can start with what you have and build from there. You see, investing isn't just for the wealthy, it's an opportunity for everyone. Before jumping in, it's important to understand the basics of investing. Let's start with the foundation. At its core, investing is about buying assets with the expectation that they will increase in value over time. These assets can take many forms, including stocks, bonds, and mutual funds. Stocks represent a share in the ownership of a company and constitute a claim on part of the company's assets and earnings. When you purchase a stock, you're buying a piece of that company, hoping that it will grow and become more valuable over time. Bonds, on the other hand, are like loans you make to a company or government entity. In return, they agree to give you back your money with interest at a future date. This makes bonds a more predictable but often less lucrative investment than stocks. Moving on to mutual funds, these are a type of investment vehicle consisting of a portfolio of stocks, bonds, or other securities. Mutual funds give small or individual investors access to professionally managed, diversified portfolios, which would be quite difficult to create with a small amount of money. Now, let's touch on some key terms. Return on investment, often abbreviated as ROI, is a measure used to evaluate the efficiency or profitability of an investment. It's expressed as a percentage and represents the amount of return you've received compared to the cost of the investment. Risk tolerance is another crucial concept. It refers to the degree of variability in investment returns that an investor is willing to withstand. In general, the more risk you're willing to take on, the higher the potential return. However, a higher risk also means a higher chance of losing your investment, so stocks, bonds, and mutual funds. Return on investment and risk tolerance. These are the fundamental building blocks of investing. Remember, the goal of investing is not just to make money, but to grow your wealth over time in a way that aligns with your financial goals and risk tolerance. With these basics under your belt, you're ready to start investing. Before you start investing, it's crucial to set your investment goals. When it comes to investing, having a clear destination in mind is as important as embarking on the journey itself. Why? Because your goals will serve as your compass, guiding your decisions and strategies along the way. So, what exactly is an investment goal? Simply put, it's a financial objective you want to achieve through investing. Now, these goals can be as diverse as the investors themselves. For some, it might be saving for retirement or buying that dream home. For others, it might be funding their child's education or starting a business. The key is to make your goals specific, measurable, achievable, relevant, and time-bound. This is often referred to as setting SMART goals. But don't just stop at setting one big goal. Break it down into short-term and long-term goals. Short-term goals are those you hope to achieve within the next 1 to 5 years, like saving for a vacation or building an emergency fund. On the other hand, long-term goals are those that will take more than 5 years to achieve, such as saving for retirement or your child's college education. Here's where risk tolerance comes into play. Risk tolerance is the degree of variability in investment returns that you can withstand. If you're a risk-averse investor, you might want to stick to safer investments for your short-term goals while taking on a bit more risk for your long-term goals. Conversely, if you're comfortable with taking on more risk, you can potentially achieve higher returns, but always remember, higher potential returns come with higher potential losses. So take a moment to reflect on what you want to achieve, how much risk you can tolerate, and the time frame you have in mind. Write your goals down, keep them visible, and review them regularly. This way, you'll stay focused, motivated, and on track. Remember, your goals will guide your investment decisions. Choosing the right platform is a key step in your investment journey. In today's digital age, a multitude of investment platforms are at your disposal. These range from traditional brokerages to robo-advisors and discount brokerages, each offering unique advantages. Let's start with traditional brokerages. They are full-service companies providing personalized advice, research, and financial planning. They are a great choice if you prefer a hands-on approach and direct interaction with a financial advisor. However, keep in mind their comprehensive services often come with higher fees. On the other hand, discount brokerages offer a more do-it-yourself approach. They provide a platform for you to buy and sell investments, but they don't offer personalized advice. This means lower fees, but it also means you're largely on your own when it comes to making investment decisions. Then there are robo-advisors, the new kids on the block. Robo-advisors use algorithms to create and manage your investment portfolio. They are a fantastic option if you're looking for a hands-off investment experience. They typically charge lower fees than traditional brokerages and often have lower minimum investment requirements, making them a popular choice among beginner investors. Regardless of the type of platform, there are three key factors to consider: fees, minimum investment requirements, and ease of use. Fees can eat into your returns, so it's important to understand what you're paying for. Minimum investment requirements can vary widely from platform to platform, so make sure to choose one that fits your budget. Finally, ensure the platform is user-friendly. After all, a platform that's difficult to navigate can make investing a frustrating experience rather than an empowering one. Remember, there's no one-size-fits-all platform. What works for one investor may not work for another. It's about finding a platform that fits your needs, your budget, and your comfort level. In conclusion, think of choosing an investment platform as a journey of discovery. It's about exploring different options, understanding what they offer, and ultimately making a choice that aligns with your investment goals and comfort level. Choose a platform that aligns with your investment goals and comfort level. Now, you're ready to make your first investment. In this thrilling journey of investing, the first step is often the most exciting, yet equally daunting. But fear not, we're here to guide you through it. Let's walk through the process of making that initial investment. Firstly, let's talk about choosing an investment. You've done your homework, you've set your goals, and you've chosen your platform. Now it's time to pick what you're actually going to invest in. This could be stocks, bonds, mutual funds, or ETFs. The key here is to remember your investment goals and risk tolerance. You wouldn't want to put all your eggs in one basket, would you? That's where diversification comes in. By spreading your investments across different asset classes and sectors, you can potentially reduce risk and increase your chances for return. Once you've decided what to invest in, the next step is to determine how much to invest. This is where that shoestring budget comes into play. Remember, it's not about how much you invest, but rather that you've started investing. Even if it's just the price of a cup of coffee a day, it's a start. It's important to invest an amount that you're comfortable with and one that won't disrupt your daily life. Now it's time to make the purchase. On your chosen investment platform, navigate to the section where you can buy investments. Search for the investment you've chosen, enter the amount you want to invest, and hit the buy button. It's as simple as that. But remember, investing is not a one-time thing. It's a journey. It's about consistency and patience. So get into the habit of investing regularly, no matter how small the amount. Over time, these small investments can add up and potentially grow into a substantial sum. Congratulations, you've made your first investment. Now you're officially an investor. Hold on to that feeling of accomplishment. This is just the beginning of your investment journey. Investing is a marathon, not a sprint. Think of investing as planting a seed. Initially, you won't see much above the surface, but with regular watering and patience, that seed can grow into a robust tree. Likewise, regular investing, even small amounts, can lead to substantial growth over time. This is due to a concept known as dollar cost averaging. By investing a fixed amount at regular intervals, you buy more shares when prices are low and fewer when they're high, effectively reducing the impact of market volatility on your portfolio. Then, there's the power of compound interest. Imagine your investments as a snowball rolling down a hill. As it rolls, it picks up more snow, growing larger and faster. That's compound interest. Your earnings generate even more earnings, creating a snowball effect that can lead to significant growth over the long term. remember, the key to investing success is consistency and patience, not overnight riches. Your future self will thank you for the seeds you plant today.